Hello, everyone, and welcome. I'm Jeff Feinstein. I'm glad you could join us for today's live discussion on what's next for opportunity zones, especially now that OZs have been made permanent through the passage of the BBB, or otherwise called OB3. We're hosting this webinar at a very interesting time when the markets are rallying. We've got historic highs, crypto also hitting highs. We've also seen an increase in business transactions, M&A, and including IPOs, which means investors are realizing capital gains and looking for smart, strategic ways to shield capital gains or to have a tax-advantaged alternative investment. At Pinnacle Partners, as you may know, we've been an early mover in the opportunity zone marketplace. We began executing in 2018. We've capitalized close to $1.2 billion of projects all across the country, aggregating close to $300 million of capital gains. We bring to you on a routine basis these thought leadership webinars. This is another installment in that series. In our last discussion, we were talking about the market volatility throughout the summer season due to tariffs, due to tax bills. That was a conversation facilitated with Steve Stroud of 3Bell, a well-known RIA. We were talking about the pair trade of a concentrated stock sale and or business sale and the use of opportunity zones. It hasn't been but maybe 3 weeks since July 4th and that the BBB was enacted into law. And with it comes what we're calling OZ 2.0 and differentiating that from OZ 1.0. And so today in our thought leadership series, we're going to break down the differences between 1.0 and 2.0, talk about the success of the program and why it became now permanent within the tax code. And there are some very unique opportunities that the BBB has presented for real estate investors at large, not just opportunity zones. So joining me today are two leading voices in the industry. First of all, Brendan McAuliffe has been full disclosure, our tax advisor since 2017. In 2017, we chose to seize upon and execute on opportunity zone legislation. We sought Brendan out as an expert practitioner, and the regs were very ambiguous at that time, and he gave us the confidence to execute, take a calculated risk in our first OZ investment in 2018. Brendan is the founder of BMMS. They serve high net worth clients and provide all sorts of accounting needs, estate, and financial planning. So we're glad to have Brendan with us today. And then my partner, Jill Homan, has been a partner with Pinnacle Partners, principally on our Fund 8 that we launched, first diversified fund and then closed. And now on our most recent fund offering, actionable fund offering in the build to rent asset class. Jill, impressively and appropriately, was named only recently as the Deputy Director of Economy and Trade at the American First Policy Institute, Jill, and was really a key advisor on the legislation for Opportunity Zones 2.0. So we have somebody very close to the program and somebody who really did influence policy as the bill was being written. And there was a lot of late night machinations and liaison work with Senator Tim Scott's office, even the White House. And we're really pleased to have Jill with us today. So that is our panel. And we're going to first talk about the BBB and some of the provisions now being afforded to real estate investors. So opportunity zones, certainly one, but there are other unique tax provisions, Brendan, that an individual should consider and potentially take advantage of. So you want to walk us through the framework of BBB as it applies to real estate investing?
Yeah, absolutely. The bill that passed on July 4th is largely a continuation of and reinstatement of policies that were already very favorable to real estate, both on the investor side and on the developer side. Some of those key provisions are the 20% pass-through deduction, sometimes called the Section 199A deduction for qualified income, which rental real estate income is, reduces the effective tax rate of that income on an individual's tax return by 20%. So it takes the top rate down from 37% down to 29.6%. Critically, I think bonus depreciation, 100% bonus depreciation, has been reinstated and made permanent. This allows businesses and owners of real estate to write off certain kinds of assets, not the building, but anything that is personal property, furnitures, fixtures, equipment, tenant improvements for commercial buildings, allows them to write off and recover the full cost of those expenditures as a tax deduction in the year those are placed in service. And that, coupled with opportunity zones, is incredibly powerful because it creates deductions for the investors, and we avoid depreciation recapture when we sell this because the full gain from an opportunity zone is excluded from federal taxable income. Varies in each state based on their rules, but incredibly powerful, incredibly big lift to the return on opportunity zone deals. And it's incredibly difficult to model that into the underwriting on this. So most of the underwriting is probably a little light on the tax benefits. Other important provisions.
Brendan, may I interject at this point just to clarify? It's a very important point. So we get to use depreciation in traditional real estate investment, but we must recapture at terminal sale that
Correct.
depreciation. In an opportunity zone, we get to utilize effective, I think, January 17th of this year, bonus depreciation, so accelerated depreciation, and we still retain the opportunity for no recapture. Is that correct?
Yes, with the exception of it's after January 19th. That's the only change I would make to what you said. Inauguration day and forward, if that's enough to think about it. Other expensing provisions, section 179, which allows, it's effectively the same result as 100% bonus depreciation, slightly different qualifications. That's been enhanced both in terms of the dollar value and what qualifies. And there's been a change. I won't bore anybody with the details on deductible interest, but there's been a favorable change that allows real estates and other businesses to deduct additional interest expense that was previously limited the last few years. Other positive changes, low-income tax credits, low-income housing tax credits, and new markets tax credits, which often get paired with real estate developments, have been enhanced. However, there's a couple of energy efficient credits and deductions that have gone away or will be going away shortly for commercial real estate. Those include section 179D, which is a per square foot deduction based on energy efficient property that has been placed in service, and 45L, which is a per home clean energy credit that is sunsetting in the middle of next year. However, I think one of the best things is that we have seen success with the Opportunity Zone 1.0 program, hundreds of billions, I think, of dollars invested into the program. Great new developments, revitalization of areas, and Opportunity Zone 2.0 under the what I'm calling the OB3 legislation gives us a lot of clarity because it has made opportunity zones permanent, and it gives us a lot of what we were asking for from a reporting standpoint and an impact standpoint on how is it impacting these low income areas. And starting January 1st of 2027, a redesignation and tightening of the requirements for which areas qualify for opportunity zone investment. And I think, Jill, you're probably best positioned to kind of talk about the nuances and specifics of everything that went behind the scenes on setting up Opportunity Zone 2.0 and how it's going to impact everything going forward.
Yeah, and before we go to Jill, and it's an appropriate segue, Brendan, just maybe opine on the difference between a temporary program, previously 1.0, and now permanence. How significant is that? I mean, we've been in this business, some practitioners, individuals were, they were interested in early days of opportunity zones, but as the benefits were decrementing over time or expiring, there was less interest. And now we have permanence.
Certainly,
Do you
certainly.
think
Yeah, no,
that's significant?
they've sort of re-upped the benefits for Opportunity Zone 2.0 over the last couple of years. One of the key benefits, which is the deferral of tax on capital gains, the time value of that has gone down. And then there was a 10 or 15% basis step up that was available for early investors into Opportunity Zone 1.0 that has been eliminated after the end of 2021. That 10% basis step up, which says if I have $1 million of gain and I invest in an Opportunity Zone fund, ultimately when that gain comes due, I'm only paying tax on 900,000 of that. So there's 10% that's permanently excluded from tax, and then you get a full 5-year deferral. The permanence gives businesses a lot of confidence to move forward with this. Other big provisions that were made permanent that really impact businesses include the R&D tax credit, which and how that's computed and the deductions associated with that. That had really it had been renewed every few years with the expectation that it was always going to be renewed. There were some big changes the last go round on this, but the permanence gives, I think, everybody here on the investor and on the developer owner side that this is part of the tax code. It can only be changed via congressional action. And so it is in there as permanent as anything can be on the tax front. And we don't have to worry about it going away overnight or with just the passage of time.
Yes, excellent. Well, thank you, Brendan. And I see questions queuing up and continue to submit those questions, and we will get to those in a Q&A at the conclusion here. So now moving to Jill. Jill, give us some insight into all the machinations, not too much of the sausage making, but crystal clear delineation as to what's changed in OZ 2.0 and how it differs from the original framework, and then why OZ 1.0, still very much in force, still matters.
Yeah, so great to be with everybody here, and I think Brendan really made a great point about permanence and what a significant accomplishment it was for our policymakers to include that. It's just, I think this is a very successful tax program, an economic development program, and is achieving its policy goals, so very significant. In terms of just big picture, some of what the policymakers were hoping to achieve and that we had heard along the way was making sure that this also worked in rural communities. And so that's why you see references to rural opportunity zones and also rural opportunity funds. And I would really view that as something to pay attention to and take a look at, and how one can have a strategy or invest, or if you live in a rural opportunity zone, utilizing one's own gains to make an investment. So those were that was one of the significant items. And another point that I'm hopeful that we'll continue to see play out through the regulatory process is ensuring that opportunity zones work for operating businesses and really expanding it beyond real estate. And then we're still working on trying to improve some things through the regulatory process to make OZs work even better. And in terms of just big picture, some of the differences between Opportunity Zone 1.0 and Opportunity Zone 2.0, we did touch on the permanence. The second is you had these provisions, as Brendan discussed, about the step up in basis, which has the effect of reducing capital gains on the original gain. And whereas in OZ 1.0, you had this time period to make an investment before you lost your step up in basis, and the dates were 2019 and 2021, which I can't believe it's like 4 years ago. So anyways, and as of 2021, we all remember trying to get our, gains in and talking with investors, and that was the end of the 10% basis step up. And so what OZ 2.0 has is it has a rolling deferral, so 5-year deferral, and then it also has a rolling 10% basis step up. And so it just enables investors to be able to receive the basis step up, receive the deferral, and have more control of the investment window, which is really fantastic and I think attractive to investors. We did touch on the rural opportunity zone and rural opportunity zones in the role that they play. And then the other significant and obvious point is we're going to have new zone designations. And these new zone designations, the governors will need to select the zones by July of 2026. And these zones will go into effect for investment in January 2027. And so really and this kind of leads into conversations that I have with folks, is just reminding them that Opportunity Zones 1.0 is still in effect. And when we really do the analysis and the financial analysis to look at what the impact of the tax incentive on an investor's potential return, what you find is that the overwhelming bulk of the return that one receives from these benefits comes from the tax-free appreciation. And it comes from obviously not paying, so it comes from the tax-free appreciation. And so when investors talk about, I'm missing out on my deferral or I'm missing out on my step up in basis, that's true, but it really doesn't comprise the significant parts of the return. And we're talking like 70-80% of the return comes from this tax-free appreciation. And so, and also the not paying depreciation recapture is what I meant to say as well. And so OZ 1.0 is still in effect. And why that matters is that, as you mentioned in the kickoff to our conversation today, is for folks, we're sitting on a really great position with our stock portfolio. Some of us are invested in Bitcoin, and we're looking at that. And maybe it's a great time for us to diversify away a little bit from certain concentrations in, maybe somebody's in NVIDIA stock or something. And so what your portfolio is today, what the zones are today, what the investment opportunities are today, and making an investment today, one is really only missing out on a very small piece of the tax benefits. And so that's what I just try to remind folks, is that this is a tax incentive that has really attracted a lot of capital. It's still in effect all the way up through to accepting investments from gains in 2026. And then following that, we'll look at what Opportunity Zones 2.0 look like. But there's, we need to see how the regulations unfold. We need to see what the new zones designations will be. And those new zone designations are based on a slightly more stringent poverty definition, where it moves from 80% of area median gross income to 70% area median gross income, so slightly poor census tracts. And we had talked about this a little bit in terms of analogy, where you have, and I did watch The Price is Right when I was sick at home from school growing up, and you have like door number one, where you see what in the Showcase Showdown, no, I'm really, and you see what you're being offered, and you don't know what's behind door number 2. And I kind of view that as the transition from 1.0 to 2.0, where, we know what we have right here, and somebody might be waiting for, new benefits and enhanced benefits and want to wait for that 2.0, but just understand that it's a risk, because, you don't know what, if you're selling out of a stock position, you don't know what that will be in the future. You also don't know where the zone designations will be. You may not know or have a deal teed up. So just something to think about. I still, obviously, I'm very excited about opportunity zones 1.0, opportunity zones 2.0. But I'm just encouraging folks to not just wait for January of 2027, but to know that this is an active investment opportunity. And you have smart practitioners like Brendan, who have really worked on a ton of deals and can work with folks and, structuring or giving very specific tax advice to help folks, make the right decision today, whether it's, investing now or investing in 2.0.
Jill, can I just emphasize that point? Opportunity Zone 1.0 used 2010 census data to determine low-income communities. And we've updated to 2020 census data for Opportunity Zone 2.0. Is that right? So the economic growth in the last 15 years in a lot of these areas that under Opportunity Zone 1.0 are technically low income. I mean, you're getting investments in some really incredible areas that you're not going to be able to invest in once 2.0 is here.
Yeah, so with the 1.0, what happened was it took the census tracts. Now I'm kind of getting into so the census tracts, the shape of the census tracts were from the 2010 census, but the data came from 2017 American Community Survey, so 2016, then later 2017. But the point is still, this is 2017. It's still data that is, at the time it was the most recent data, because this, as you know, was a tax bill at the end of that year, and so it used the most recent data, but when it made the zone designations, but now the data is old, and so with this new Opportunity Zones 2.0, what they'll be using is the shapes from 2020. So think about it, if a census tract may have started out here and made it like be maybe like a rectangle, and now it's kind of like a little bit of a circle. And then it's going to pull in data from the American Community Surveys, so some of the most recent data. And so that's why I think we'll be looking at, not in all instances, but you very well could have a zone that was designated 1.0 that's designated 2.0, but you're likely to see not only some shifting around in terms of census tracts, but even like the shapes of the census tracts could be also changing.
So a lot there. Thank you, Jill. And I just want to reinforce a couple of items. So Brendan talked about permanence and the power of permanence into the tax code. I think we're going to get significant interest in executing on 2.0 and continued interest in 1.0. And you were making the case for why 1.0 matters, and I'll come back to that in a moment. With regard to rural zones, and you talked about the step up in basis, so let's just kind of ground ourselves. At the time of investment on an ongoing basis in 2.0, you will earn a 5-year deferral. You invest in 27, 5-year deferral, 28, 5-year deferral. Again, previous legislation had that expiring over time. So no matter which year you invest, you earn the 5-year deferral and the 10% step up if it's an urban zone. But in the rural zone, and you spoke about now 30% of all census tracts, OZ zones, will be rural designated, they earn a 30% step up in basis. And that's quite significant. And we are paying close attention to these rural zones as they emerge and become clear. The other consideration in rural is that you have, as I understand it, no longer 100% substantial improvement test, but a 50% substantial improvement test, meaning you could potentially buy an existing asset, put value add or adaptive reuse to that asset and meet the compliance for the legislation. So Jill, can you just confirm for me I'm correct. A
Yeah.
30% step up and a 50% substantial improvement test.
Yes, so it's in rural opportunity zones, the step up in basis is triple in rural, as you mentioned, and the substantial improvement was in half. And so if you imagine that you have $100,000 gain, and in a non-rural opportunity zone, your step up in basis and your, the taxes you pay on that gain would be reduced by 10%. In a rural, it's reduced by 30%. And in the example of the substantial improvement, if you imagine you bought a building for $100 a square foot with $20 in land, you would have to put another $100 plus in order to double the basis, meet that 100% threshold in a non-rural area. In a rural area, it's $50 plus. So, and it makes sense, right? Because if you think about in a rural area, your dollar goes further versus in a non-rural area. But also the policymakers were really trying to incentivize capital into rural areas, as I mentioned, because what they found in a report is that when you break down kind of the rural to non-rural investments, that the rural areas were underrepresented with investments. And so if you enhance the incentives and make it slightly less risky by requiring less capital, the idea is, you're kind of like meeting that risk return, enhance the return, reduce the risk to attract that capital. And that was really the intent there with these rural incentives. And the definition of rural is 50,000 or less, and also not adjacent to another 50,000 or more community. So think of it as really trying to avoid suburbs, like pure suburbs, and that's kind of your definition of rural.
And it could be college towns. We saw a lot of student housing activity in college towns or resort towns, or other rural locations that might, I could see the need for all sorts of different product types there, built to rent or storage or light industrial. So it's an exciting add-on to OZ legislation. Now, pivoting back to 1.0, the way I see it now, let's remind the audience there are three significant tax benefits from the investment of a realized short or long-term capital gain. So you get deferral. We've been talking about that, 5 years in the new program. Currently under the 1.0 program, it's through December 31 of 26, payable April 15th of 27. So there's still a small de minimis amount of time allowed for deferral. The offset, I think, as Brendan posited earlier, is we still, in 1.0, get to take advantage of bonus depreciation in 25. So an OZ 1.0 investment can, depending upon the projects and their maturation, can qualify for bonus depreciation. So that may, that's a lift, I think, to 1.0. In addition, you continue to use depreciation throughout the holding period without recapture. We talked about that briefly. That's a powerful tax efficient component of OZ investing, because you get 100% step up. By the way, we use the term step up in basis. Let me just demystify that for a moment. That's a as it's applied to the deferred tax in the 5-year example, or the 30% step up in the rural example. That's a discount on the tax owed. That's what step up means. I owe 100%. It's deferred, yes, but now I pay 70% of the associated tax. That's a significant incentive. So that's what step up means. But continuing with 1.0 benefits, depreciation without recapture, and then finally tax exemption. I think both Brendan and Jill were pounding the table on that is the most powerful component of OZ investing, tax exemption. That is, you pay zero capital gains tax on the appreciation of the real estate investment. So the investment goes in at $100, now worth $400. The $300 in appreciation is tax-free after a 10-year hold. And that is extremely powerful. when compared to alternative taxable investments, where you make the investment, you sell the investment, you pay the tax, you make the investment, you sell the investment, and continue to pay the tax. So we've illuminated the benefits of within the BBB applied to real estate investing. We've kind of distilled the differences between OZ 2.0 now made permanent in the BBB and why 1.0 matters. We're getting a number of questions in, so let's have those questions continue to come and ask our expert panel. I'm also going to launch this poll question. I hope that's been presented on the screen. Somebody tell me if it has.
Yeah.
But we're interested in your thoughts. So the first question is relative to the administration of the program. So Brendan, this is appropriate for you. How do you document your OZ investment and the qualified gain, and do separate question, do fund managers provide 1099s to show those cap gains in 2026? So I think probably some clarification there, but Brendan, can you talk about how easy this program is to administer with you, the CPA practitioner, and your clients?
Yeah. I look at OZ compliance as sort of two-pronged. There's fund level and then there's investor level. The fund level requires semi-annual testing. You have to make sure assets are invested correctly into the proper kinds of assets, that you're generating the right kind of income. That gets reported annually. That gets reported.
And that's on us.
The fund level, yes. On the partnership.
Let's talk about the client. Yeah.
On the investor side, the OZ reporting is pretty straightforward. In the year where you make an opportunity zone investment, you say, I have a capital gain. You report that on your tax return. And then you say, I also invested that gain into a qualified opportunity fund. You list out the tax ID number of the qualified opportunity fund, and then you just back out from your taxable capital gains how much you invested. You can't invest more than your capital gains. I think that's a critical point, and get the tax benefits. The tax benefits are associated with the deferred capital gains. I mean, you want to own this deal because it's a great deal to begin with, but if you just invest non-capital gain dollars, you don't get any of the tax benefits. But if you did invest capital gain dollars, you then have an annual reporting requirement, an additional form that you file with your personal tax return that just says, this is the qualified opportunity fund that I invested in, here's when I invested in it, and here's the kind of gain that I deferred. So from a reporting standpoint, the investor is responsible for tracking their deferred capital gains and reporting their deferred capital gains, both initially on an ongoing basis, and then finally at the end of 2026 when the gain comes due. The OZ fund managers will not be issuing 1099s to anyone.
But they will issue K1s, correct?
You get yes, assuming you're invested in a partnership, you get a K1 every year. There's no current disclosure requirements on those K1s, so the fund managers are not obligated to report anything. And there hasn't been enough discussion, I think, in the community as to come to what a sort of best practice is going to be at the end of 2026. But ultimately, it is the individual investor's responsibility under OZ 1.0. Now, there are enhanced reporting requirements in OZ 2.0, both for the underlying businesses, the funds, and the information that they provide to investors. But those aren't relevant until 2027 or later.
Brandon, these are conversations that investors have before they make an investment. Obviously, is getting this whatever reporting that one needs is a function of more of investing in a real estate private equity deal than really an OZ investment deal. And so if someone has particular timing with their tax returns or specific things and questions, it's a conversation with your fund manager in advance of making an investment decision. But that's really specific on making a real estate private equity deal, and it's nothing mandated through OZs.
So we call it self-administration, and Brendan described how it's done, and you attach a singular form to your personal return. Let's also remind ourselves that you have 180 days from the realization of a short or long-term capital gain. So that's like looking forward 180 days from now for a planned sale. You could also look backwards 179 days. Any sales you may have made could still qualify. And Brendan, just very briefly, please, on a capital gain realized from a stock sale, there's a timestamp. It's pretty clear when you start the clock. But on a partnership K1 gain, which it could be mutual funds or hedge funds or private equity funds distribute these partnership K1 gains, unfortunately, increasingly late to you, the client and the practitioner. There are multiple dates in which the 180 clock starts. So briefly, could you just tell the audience what those 3 dates are?
Yes, I hear you saying briefly. I won't go too far.
Yes, thank you.
If you recognize a gain as an individual, your 180-day reinvestment clock starts on the day of the sale. So it's the day of the sale plus 179. For a gain that flows through to you on a K1, either from a partnership or an S corporation, you can start the 180-day reinvestment period on the day of the underlying transaction, the end of the entity's tax year, which is generally December 31st, or the original due date of the entity's tax return, which generally is March 15th. So in effect,
you get one March of those 3 days of the next year.
Yeah. I mean, if you look at 2025, for example, if you sold something back, January 1st of this year, your 180-day clock as an individual has expired. But if that gain came through to you on a partnership and you had not made any OZ investments prior to now, you can choose to have that clock start on December 31st or March 15th of next year and potentially invest all the way into early September of next year for a gain that you recognize back in January of 25.
Very good. So if you derive a partnership gain, you got a lot of flexibility, potentially extended timing to qualify that gain for OZ tax treatment. Remember that you invest the gain and the basis is put in your pocket tax-free, and the OZ does not require the investment of the entire gain. It's all or part of the gain. So the OZ, when compared to 1031 and even QSBS, and there are not many extraordinarily significant tax shields like the opportunity zone legislation provides, but it also from any source, but it also does not prescribe the fact that you must invest the entirety of the gain. So a lot of flexibility there. By the way, in the scenario of the 3 dates, we've seen some of our investors get a refund on their estimated tax payment because later they made the OZ investment and obviously deferred the tax. So getting some more questions here. One of the key strategies of 1.0 as it applies to Pinnacle Partners funds was to refinance or return capital at refinancing and obviously distributions ongoing from income. Does any of that change in 2.0? I guess, Jill, I ask you the question.
No, I don't know if you want to get into, Brendan, the tax code, but the short answer is no. From a practical matter is the big picture business plan is very similar in terms of zero basis investments. You get your basis from pro rata allocation of the debt, the permanent debt. And when there's a refinance upon, let's just say construction of a building, a refinance into permanent debt, then there's a debt finance distribution, and investors would get their pro rata share of the debt finance distribution. Now, I know Brendan's probably cringing because I kind of skipped over like inside outside basis and not quoting tax code. So I'll let him fill in the blank on all that. But that's just big picture. The business plan stays the same for OZ 1.0 and 2.0 if it's, major rehabs of buildings or building new buildings on the real estate side.
Now, you asked, do I want to get into the tax code? Sure, I do. Does everybody else want me to? I think the answer is no. So we'll leave it at high level. I agree with everything you said. Debt finance distributions are specifically allowed in the regulations for opportunity zones, which allows for you to get some cash out, a big chunk out prior to the expiration of the 10-year hold period. So a lot of times people talk about opportunity zones as you can't touch your money for 10 years. It's not entirely accurate. You can certainly get some money out beforehand through ongoing distributions and refinance. And that, again, that bumps the IRR. The only caveat to that is you have to wait at least 2 years to get a debt finance distribution. And we have seen a couple of projects that have been built, stabilized, and refinanced within that period, and they had to sit on the funds for a little bit before they could do the distribution.
So it's a performing real estate asset. It distributes cash through capital event like refinancing or income producing distributions, and all of that is allowed. So it can be a cash flowing investment in addition to the tax shield and all the aforementioned benefits. So let's we'll look to wrap up here shortly, but we got a couple free questions remaining. So to be clear, OZ 1.0 is in force through December 31, 2026. That's the last day in which you can make an OZ 1.0 investment. OZ 2.0 begins January 1 of 2027. There is no overlap. Okay, so I'm asserting that. Jill, I asked for your confirmation. Is that a correct statement about timing and no overlap?
Yes, and that was really what I would say the staff / policymakers had wanted, is for there to be kind of a beginning and an end. And so, we can kind of get into all the nuance of that, but essentially the investors have until the end of 2026 to harvest the gain. And so there's, ability to invest beyond that. But I would just think of what we're really going to see is for those who have projects, who are working on capitalizing projects after 2026, it's really going to be driven by the sponsors and fund managers who still have projects that are seeking capital that that will trail into 2027. But for the investors and for the fund managers, new fund managers, I expect then they will be focused solely on, okay, in 2026, towards the end of 2026, I want to start marketing my fund and really focusing on attracting investors who are harvesting gain for new fund investments. But at a high level, what policymakers are trying to do is to have like a beginning and an end with OZ 1.0 and OZ 2.0.
And therefore, we don't expect, I know we were discussing this before the webinar, we don't expect a 1.0 project could be funded with 2.0 investment unless it was retained in the 2.0 maps. Is that a correct statement?
Well, I mean, you could always put non-gain dollars.
You can, and yeah, that's right.
You could say, say there was a slug of capital that you still needed, maybe to enhance, and attract that capital, you might offer them, hey, we'll give you a pref to invest.
Yeah.
But there's not really an ability to, mix the benefits and mix the zones unless the 1.0 zones are designated as 2.0.
I got a few closing comments, if I may. First of all, Brendan has always been available to any one of our investors or prospective investors to get into a forensic discussion about your scenario. And so we continue to make that available to anyone that's attending today. Jill, as mentioned, is as close to policymaking as we have access to. We also rely on Novogradac, but the two combined give us, I think, an edge in understanding what 2.0 looks like. And so we're actively strategizing on fund formation futuristically. Meanwhile, we continue to have our 1.0 offerings. Some of you may know we have a single asset in Hollywood, which is kind of a response to the wildfire disaster to build workforce housing in Hollywood, California, and our multi-asset BTR fund, which I think is an exciting asset class in the Southeast. So those are actionable funds, and we continue to work with individuals desirous of 1.0 OZ investing. They've realized a gain or they plan for a gain. And this is again an ongoing series of interesting conversations with thought leaders like Brendan and Jill. So go to our website. We've got those webinars previously hosted and recorded, and this one will be the same. And we do encourage, please, any questions after this webinar, send them our way. Any interest in moving through an illustrative example of, I've got this scenario, partnership gain or otherwise, we are happy to engage with you. And I thank you, Brendan and Jill, for being available for this conversation and our partners here at Pinnacle Partners. So thanks everyone for your attention.